Talk about something that's been all over your feed lately. People saying that the housing market is about to crash. It's 2008 all over again. Here's the thing, it's not, and it's not even close. I'm gonna walk you through some real numbers, real charts, and real data, not just clickbait headlines. I'm gonna show you why today's housing market looks nothing like it did in 2008. So grab your coffee. By the end of this video, you're gonna be able to spot the difference between facts and fear. In 2008, we had 2.3 million homes in foreclosure filings. The next 2 years, even worse, over 2.8 million foreclosures per year in 2009 and 2010. That was 2.2% of all US housing units going into foreclosure. Now let that sink in for a second. Now look at today. In 2023, we had 357,000 total foreclosure filings. That's 0.26% of housing units. That's about 1/9 of what we saw during those crash years. Now back then, people were walking away from homes left and right because they had no equity. They had no stable loan structures. Adjustable rates reset, payments doubled, and stated income loans where you could literally just say you made $150,000 a year and this blew up in lenders' faces. Today's borrowers are qualified, they're verified, and they're vetted. They've actually been stress tested at higher interest rates, and more importantly, they have equity. Now take a look at this Housing Wire chart. This shows that the majority of US homeowners have less than 60% loan to value. That means they own at least 40% equity in their homes. In other words, homeowners have a cushion. Even if prices drop 10 or 15%, most homeowners wouldn't be underwater, and it's not even close. In fact, according to CoreLogic, only about 2% of homes in the US are considered underwater right now, meaning the loan amount is higher than the home's value. Compare that to 2009, when over 25%, 1 in 4, mortgages were underwater. So let's be clear, this isn't a bubble built on debt. It's a market supported by real equity and actual real ownership. So let's shift gears a little bit and talk about supply. In 2006 and 2007, inventory skyrocketed. You can literally see it start climbing in 2005, the second half of 2005. By the time 2008 hit, there were 4 million homes sitting on the market. Builders were overproducing, speculators were flipping, and buyers had multiple primary residences because lending standards were just basically non-existent. Now look at the opposite trend. The blue inventory chart today. Inventory collapsed after 2011 and has stayed historically low ever since. In early 2025, we were sitting around 1 million active listings nationwide. That's roughly 1/4 of what we had before the crash. Low supply, high demand, this equals price stability. Even if rates are higher, people still need somewhere to live. Builders aren't keeping up. Homeowners aren't selling, and because they're sitting at 3% mortgages, they're probably not going to sell. This tight supply is why prices have not crashed, and essentially why they're not going to crash. Now let's look at the credit markets, because this was the other big factor in 2008. Back then, you had massive defaults in every sector: personal, corporate, and mortgage credit. Banks were collapsing. Lehman Brothers disappeared overnight. Today, banks are better capitalized, lending is more regulated, and mortgage-backed securities are cleaner. There's no widespread mortgage fraud, no ninja loans, no income, no job, no assets, you're all good, and no secondary market meltdown brewing under the surface. If anything, the pendulum has swung the other way. Getting a loan today is harder than ever, and that's not a weakness, that shows stability. Now, could home prices soften? Of course. Real estate is always cyclical. If rates stay high, we'll see some regional slowdowns, but a nationwide collapse like 2008, there's absolutely no shot. To have a crash, you need millions of forced sellers, foreclosures, bankruptcies, and panic listings. Right now, homeowners aren't forced to sell. They have equity, they have jobs, and they have fixed rate mortgages. So until inventory builds up and credit markets collapse, there's just no mechanism for any type of crash in the near future. So here's the truth. Today's housing market isn't propped up by fantasy financing or speculation. It's supported by fundamentals. There's less inventory, there's more equity, there's healthier borrowers. Now, people screaming crash are looking at clickbait headlines. They're just simply not looking at data. This isn't 2008, it's 2025, and the fundamentals are stronger than ever. If you found this helpful, hit subscribe, drop a comment, and share this with somebody that's waiting for the big crash. I'm telling you, it's not coming, and I'll keep showing you the data to prove it. I'm Steve Saxton. This is All Things Money.